Good morning. Thank you all for joining. My name is Bianca Simmons. I am the Pro Bono Programs Coordinator with the North Carolina Bar Foundation. And today we have with us Jeffrey Hart, who will be presenting a presentation on minority equity investments. To give you a little bit of background about Jeffrey, he joined Robinson Bradshaw in 1997 and opened the firm's Research Triangle office in 2008. His primary areas of practice include private equity financing and investment, joint ventures, and private fund formation. Jeffrey regularly designs complex capital and funding structures, governance, and operational systems, and buy-sell mechanisms for investment sponsors, joint venture parties, and other clients needing highly customized business solutions. He does it all. Jeffrey works extensively in the formation of private funds, including venture capital funds, private equity funds, real estate funds, and funds of funds. He assists corporate venture capital programs, private funds, endowments, and other financial strategic investors with their investment transactions. From 2019 to 2023, Jeffrey served as the Chief Legal Officer and General Counsel to Modern Energy Group, a diversified holding company investment firm with foreign and domestic portfolio companies in energy efficiency, distribution, generation, demand response, and energy storage. In 2023, Jeffrey rejoined Robinson Bradshaw as a shareholder in the Research Triangle office. I will now pass it over to Jeffrey. Enjoy the presentation and please feel free to ask questions at the end.
Thank you very much for that kind introduction. I appreciate it. And looking forward to presenting this today. Minority equity investments is a pretty big topic, probably biting off a little bit more than I can chew here, especially with the time constraints involved. But we'll probably do the best we can just to get through a lot of subject matters and topics associated with equity investments in companies, just to lay the groundwork, to lay a foundation. And then you can get into more deeply into topics, into different aspects of it later on. But so, one way to think about minority equity investments is that this is a way to finance a small company or a big company, but it's mostly a privately held company through the issuance of some kind of equity security. That is entitling the holder of that equity security to economic rights associated with the business of the company going forward. And minority rights are usually situations we're talking about where someone is investing in a company, but they're not controlling the company. They're not buying the company. It's just an equity investment, and they're more of a passive owner in the company. And they may be making that investment for purely financial purposes to get a return on their money. It could be strategic in nature, where they are investing in a commercial partner or someone with whom they want to have a business relationship now or in the future. And so they're making an investment to kind of seed that relationship. You could have situations where you have investors who may invest enough capital to have a majority ownership position, but it's not a controlling position. Again, they still intend to be passive. You could have joint ventures between two companies where one is a majority owner in the venture, one's the minority owner. And then you can also have sort of funds, private equity funds and other groups where they're in the business of making investments in companies and put a portfolio together. In all these situations, you're probably going to run into situations with requests for minority rights where, yes, they don't have a majority position, they don't have a controlling position, but they still want some rights and protections associated with their investment instead of being completely passive and not being able to influence the company in any way on a going forward basis. So a couple of ways that companies are typically structured that are bringing in portfolio company investments and equity investments. And a lot of this there's a lot of tax planning involved, the type of business that the company is going to be, how it's going to monetize the equity, how it's going to have a business model going forward. All of these things can affect whether the company should be a subchapter C corporation or a limited liability company. I know there's always a lot of talk about S corporations, but I think in this context, S corporations aren't a great vehicle or aren't a common vehicle, at least in my experience, for bringing in minority equity investments because they're only U.S. citizens and U.S. natural persons typically can be investors in an S corporation. You can only have one class of stock in an S corporation, and a lot of times a minority equity investment is in a different type of class of stock that is one held by the other owners or the founders. So the two most common structures are a C corporation and a limited liability. As you probably know, a C corporation is a two-level of tax type system. The corporation pays income tax, and then when dividends and distributions are made to the stockholders, the owners of the corporation, they're taxed as well. A corporation is subject to a corporate statute that has a lot of rules, a lot of procedures, and a lot of case law associated with it. So it's a much more structured entity. I think a corporation typically, if it's a C corporation and subject to two levels of tax, a lot of times I think a minority equity investment is the type where they are expecting some future type of liquidity event. It's not an ongoing business that's making cash distributions every year, because that's not necessarily the most tax efficient way for that entity to operate, and not making lots of dividends, but in the private company context. But it's usually something where we're going to sell this company down the road, and we're going to recycle and reinvest the cash flows that the company is making. And that goes into hand with a small company can qualify for Section 1202 business stock, qualified small business stock, which really enables minority investors to get some some tax avoidance, or not tax avoidance, but tax exempt status on some of their stock when the liquidity event does occur, and so that there's a special tax benefit that can be associated with that. And then companies often are looking at the issuance of incentive equity. And what I mean by that are stock options or restricted stock or other types of equity investments to employees who are making a big contribution to the company and are expecting to participate in some type of the upside equity distributions going forward. Limited liability company, typically they're classified as partnerships for tax purposes, where the entity itself does not pay income tax. Everything is it's on a pass-through basis. Profits and losses to the owners are often called members in an LLC context. A LLC, like a partnership, is really a creature of contract. It's there's a lot of freedom of contract. There are very few default rules that can't be preempted or superseded by a contract. And so they are very flexible entities. And I personally, for example, work with a lot of LLCs. I think a lot of private equity groups are moving more towards LLCs and not working as much with C corporations unless they're a startup company that that really is only going to monetize itself in connection with some kind of liquidity event. So if you have a company that's expected to make regular distributions on a standard basis, then an LLC might be a better structure for the company to be a recipient of a minority equity investment. Again, you can have incentive equity in an LLC context. They're structured a little bit differently a lot of times. They're not stock options. They're in the form of profits interests. And you also have to be concerned, or not be concerned, but be mindful of the fact that when employees are holding equity in LLC, they're actually not W-2 employees typically. They're self-employed for tax purposes. They're having to pay their own self-employment taxes, estimated taxes, paying those on a calendar basis. And so they can be a little bit more complex from an employee ownership standpoint. We move to the next one. So one thing that is really important to keep in mind when you have a company that is seeking investors and looking to sell securities to raise capital for operating expenses, development expenses, capital expenses, whatever it might be, that is an offering of securities for federal and state securities laws purposes. So anytime you are selling securities, that offering either needs to be a public offering, which is like an IPO, and obviously those don't happen very often. They're big transactions, they're expensive transactions, they're heavily regulated transactions. Or you have to qualify for an exemption from those registration requirements. And so most private companies, they're engaging in private securities offerings that comply with some kind of private placement rules or set of rules, both at the federal level and at the state level. In my experience, most companies that are bringing in minority investors are trying to raise money under one specific exemption, which is called Rule 506B. That's an exemption under Regulation D of the Securities Act at the federal level. It's one of the few federal level exemptions that also preempts state securities laws, which is really important, especially if you're trying to raise money from folks in a variety of states where trying to comply on a state by state basis with their securities laws can be important. So when you do a 506B offering, um, you can't engage in a general solicitation of investors, and I'll talk about that in just a moment. And really, all of your offerees should be what are called accredited investors. And accredited investors can be individuals or entities that usually have some type of financial uh, baseline. They have a net worth, or they hold assets of a specific value, or they meet certain income tests, and so that's an important thing, because if you start trying to issue securities to people who are not accredited investors, there are a lot more rules that can apply, especially under 506B, a lot of informational requirements, disclosure requirements that can go beyond what might be practical or administratively convenient for a company. So again, in doing a 506B offering, or really almost any private offering, you can't engage in a general solicitation. And that means you can't just go out and publicize or do seminars or send out mailings or anything like that and to try to generate investment interest in your company. You have to do much more targeted one-on-one or small group um, meetings or conversations and discussions. And those need to be with people with whom you have what's called a pre-existing substantive relationship. So that's a two-part relationship. It's pre-existing, which means it exists prior to the offering, prior to the investment opportunity. And it's substantive to the point that you have a reasonable belief that the person you're speaking to has the sophistication and experience to be able to properly evaluate the merits and risks of the investment. And so, for example, if you know that you have a mailing list, and everyone on this mailing list is a really high net worth individual, it doesn't matter if you don't have that pre-existing substantive relationship. An offering of securities to people who may meet the financial requirements, but you don't have that qualitative relationship with them, is going to be a general solicitation. And so those procedures really need to be followed, and you need to be careful and deliberate when doing a securities offering. All securities offerings are subject to anti-fraud requirements. You cannot make a material misstatement or make an omission that makes another statement materially misleading. And then when you do a 506B offering and you're complying with that safe harbor private securities registration exemption, you will file a Form D with the SEC and in the states in which you have investors residing or domiciled. And that is a public document. It doesn't have a lot of information on it. There's quite a lot of information you can include on it. Some of it's optional, but it is a public document, and the press, the media follow those and monitor those. And so when you file a Form D and you show that you've engaged in a securities offering, it's very common that you're then going to get some kind of a request for comment, and journalists will reach out to you to hear more about the opportunity. And that's really, unless the offering is completed, that's really something that you can't engage in, because that still continues to represent a general solicitation. So when you're doing a securities offering, you're coming up with a capital structure. What's the capitalization of my company going to look like from an equity security basis? And what are the economic terms associated with all these different securities? And so you may hear about, what's the pre-money valuation of your company? A really simple, generalized example is, let's say I have a company and I believe its pre-money valuation, meaning the value it is today before I go out and raise any money and bring in capital, is $100. And then I sell securities to someone where they're investing $50. On a really simple basis, now on a fully diluted ownership basis, I own 2/3 of the company and they own 1/3 on a post-money basis. Pre-money value was $100. They invested 50. Therefore, the value of the company goes up by 50, the cash inserted into the company. So now it's worth 150 on a post-money basis. And generally speaking, someone's going to expect a percentage ownership in the company based on the capital contributed, the capital invested over the post-money valuation of the company. It doesn't have to work that way. That's a really simple example. It's very often that minority equity investments are in some kind of preferred security that have more economic rights other than just we're going to participate in everything on a proportional basis based on our percentage ownership. So preferred equity, for example, it may be that I'll invest in your company, but what I expect is to get my money back first. I want my capital back first, and then maybe I want some kind of preferred return on that amount as well. Maybe it's, I want 8%, calculated like interest, or maybe I want what's called a MOIC, a multiple on invested capital, which is like 1.5 times my money back. So those are capital stacks that you can put together where there's preferred equity, there's common equity, you have incentive equity for employees, and they're all participating at different stages and in different amounts based on what the parties negotiate. The investment can be put in a lump sum amount. It can be put in installments. Those installments could be based solely on a schedule and the passage of time. It can be based on milestones that have to be hit by the company or certain types of triggering events. And there's just a lot of ways you can structure these investment transactions. You can even start splitting apart, excuse me, what type of cash proceeds or cash flows the investor is participating in. And they could participate in those different cash flows in a different manner. You could look at cash from operations versus cash coming in from some kind of liquidity event or sale of the company. And all of that is up for negotiation. An LLC format, it's a lot easier to structure a lot of these things because they just have a lot of flexibility. Corporation, you can, again, get to the same place a lot of times, but they're just a little bit more complicated, a little bit more rigid. So distribution waterfall is kind of what I was just referring to. And that's a term often used by, okay, if I'm taking out a set amount of money, if I have a company that's going to make a distribution of $1 million and that goes through the capital stack, who's getting what? And again, you might have a preferred equity security getting something first, then they are participating with the common equity, or they then convert into common equity, and there's some shared ownership there. And you can structure that waterfall, and that's often one of the most negotiated aspects of a minority equity investment is what's going to be the distribution waterfall? What's our business deal? And that's how it's manifested. You might have, you also may have negotiations over how often do we distribute cash flow? Is it up to the board or to the founder's pure discretion when to make dividends and distributions? Or is the minority equity investor saying, no, you've got to make mandatory distributions or dividends on a scheduled basis or based on how much excess cash flow you have? And that's trying to balance the investor's ability to monitor or to monetize their investment while the company wants to recycle and wants to grow and wants to reinvest those proceeds in the company going forward. In an LLC context, as I mentioned earlier, a lot of times it's taxed as a partnership. There's no partnership level tax, but the members, the owners are getting taxed, and they don't want to be taxed on income that's being allocated to them by the company without the cash to pay the taxes associated with that. So a lot of times in an LLC context, you'll have what are called tax distributions, which at a very minimum, the company, the LLC, is making distributions to its owners so they can pay their income taxes on the taxable income, if any, that's being allocated to them. Another right that a minority equity investor may often ask for is some kind of anti-dilution protection. And that's really trying to protect the value or the ownership percentage that they have when they make the investment transaction. So a value-based anti-dilution protection mechanism may be that, if I buy shares in a company and make an investment for $1 a share, I need some kind of adjustment to what I own in the company. If you then go sell shares for 50 cents a share, so now my investment, the value just got cut in half. And so there might be some adjustments and mechanisms in there to make sure that I get some kind of increase and bump up in my investment size to help to preserve the value. Another concept that you often see are preemptive rights, they're often called pro rata rights as well. And that is, if I invest in a company, let's say I take a 20% ownership percentage, when you go and invest in the future, I'm going to be diluted unless I'm given an opportunity to buy my pro rata share of those additional securities. So I may want to preserve my 20% ownership percentage as the company continues to grow and bring in more capital. A preemptive right allows me to do that. It gives me the right to participate in future securities offerings by the company to maintain my percentage ownership. I'll talk about just incentive equity briefly, given time constraints. But incentive equity, as I mentioned earlier, is compensatory equity that you're often issuing to employees to supplement or to augment the cash compensation that they're receiving as well. A lot of times these equity arrangements are subject to vesting, meaning that they really only have the right to the economics associated with the equity over time. So if you hear, 4-year straight line vesting, that means that an equity investment that I might get as an employee, let's say I get 100 shares, for compensatory purposes, my vesting is 25 shares per year over 4 years until they're fully vested. So if I leave during that time, I'm losing my unvested equity. There may be a purchase right on my vested equity. And so those designs and structures are intended to incentivize me to stick around for 4 years, not just take the equity and now I'm going to quit and go with it. The structure of incentive equity is different and can be different for corporations versus LLCs. Both can have options, but as I mentioned earlier, LLCs often have profits interests. When you think of a share of stock in a corporation, that share represents two things at any given time. It represents a percentage of the historical value or the current value of the company and a percentage of future profits and appreciation in that company. In an LLC context, you can actually break those two things apart. One is the capital interest, which is the current value of the company, and one is a profits interest, which is a future value in profits and appreciation. When you give a profits interest to somebody, that's actually not taxable to them because it technically doesn't have any value on day one. It has value from that point going forward. So if I have a company that's worth $100, and I give somebody a 1% profits interest going forward, the first $100 that comes out of the company, they're not going to participate in, but they'll participate in 1% of every dollar in future profits and future appreciation going forward. And so those can be very attractive structures from a tax perspective compared to corporate incentive equity. And that really goes into a lot of the planning around structuring a company, planning what the capitalization will look like, and trying to customize that and design it to fit that company's business model and projected form of monetization and cash flow going forward. Incentive equity, in a corporate context, you can continue to be a W-2 employee. Again, in a partnership context, unless you're employing pretty complicated structures, tiered structures of partnerships, you're going to be self-employed for tax purposes. As I mentioned earlier, a profits interest, you have this, in my example, was $100. You're participating in profits and appreciation above $100. That $100 amount would be considered the hurdle amount or the distribution threshold. Those are terms that are commonly used that are associated with that profits interest. And there is an analogy in corporate stock options. If I have a stock option that allows me to buy, I usually have an exercise price that I have to pay. And it's going to be similar to that hurdle amount to make sure that I'm really only appreciating or participating in profits and appreciation on a going forward basis. Because incentive equity for employees can be complicated, a lot of times they're not as tax efficient, but the advice would be, let's just use bonuses instead. I mean, those are subject to ordinary income tax and employment taxes, which may not be true in the option or profits interest context, but they are a lot simpler to administer. And there's just a lot of flexibility around those as well. As I mentioned or alluded to briefly, when you have incentive equity, you can subject it to vesting, you can have redemption rights, you can have put rights, you can make it voting or non-voting. You often may attach employee covenants to it, such as non-competes and non-solicits and confidentiality covenants that go along with that equity, and all that can be structured and negotiated. So typically with a minority equity investment, the minority investor is going to want some ability to at least influence or have a voice with respect to the governance and management of the company. It could be so minute as the operational day-to-day affairs of the company, or it could be just big transaction matters like a sale of the company or a capitalization of that, the incurrence of debt or the issuance of securities. And so a lot of these companies, typically a corporation is always going to have a board of directors. In an LLC context, you can have a board of managers, which has a similar role. The minority investor may want the right to appoint a director or manager and sit on that board and participate. They may want to be a board observer where they come and they get to observe the meetings and participate in the meetings, but they really don't have a vote and they're not necessarily subject to fiduciary duties. So when someone is a director or of a corporation or a manager of an LLC, the default rules are that they are subject to fiduciary duties of care and loyalty. So if I am a minority investor, I'm investing in a corporation and I'm going to sit on the board, I really have a fiduciary duty of care and loyalty to the company as a whole. I just can't use that position to take actions and to vote solely in my self-interest when those are to the detriment of other stockholders or the company as a whole. So those fiduciary duties have to be taken into account when making a minority equity investment. And to avoid those fiduciary duties, you might have transactions or consent rights or transactions that are subject to consent rights in someone's ownership capacity, where those same fiduciary duties may not be in play, especially with minority equity investment. So if I made that same investment, but I'm going to have a consent right over any additional issuance of securities or any issuance of debt or any sale of the company or any dissolution of the company, and I'm going to have those approval rights in my capacity as an owner as opposed to a member of the board, then I'm probably not going to be subject to those fiduciary duties unless I have a majority and controlling interest. In an LLC, they can be much more customized and you can restrict or eliminate or modify those fiduciary duties. You can't do it as much in a corporation, so you can be more flexible in an LLC format to ensure that that the parties' expectations about how the company will be governed and in whose interest they can be looking out for when they take actions can be properly documented in that case. Another thing that often takes that takes some discussion during a minority investment transaction is how conflicts of interest transactions are going to be handled, who needs to approve them, what level of approval is required. And then a lot of times you're getting into deadlock situations too. If a minority investor has a consent right or an approval right on a block of actions, and the company, that person is constantly exercising that veto or that approval right, and the company is unable to move forward, you might get into deadlock situations where it's a good idea on the front end to negotiate and to structure how we deal with deadlocks and how do we get ourselves out of a standstill position so that the company can move forward. This is kind of repeating a lot of what I was just talking about. The veto rights often are called sort of negative control rights or the approval rights, and they could be operational matters such as over the budget, new businesses, excess expenses, material contracts, key employee matters, acquisitions, filing lawsuits. Those are much more ordinary course day-to-day affairs. And sometimes a minority equity investor that wants to be more heavily involved in the business may want voting rights associated with those matters. A more passive investor may be looking more at just capital transactions. I want to be involved and I want to have a say when you're issuing equity, you're incurring debt, you're going to sell the company or a subsidiary or a key asset. You're going to think about a bankruptcy filing. You're going to redeem equity and buy it back, which may put that equity in front of me from an economic perspective. And those are the types of things that maybe a more passive investor would be concerned about. Tax matters also are a pretty important area. For example, if I'm an investor and I invest in an LLC taxed as a partnership, and I expect that type of taxation, I'm probably going to want to have a say if that LLC makes a check the box election to become a corporation for tax purposes or converts into a corporation, because that's really going to change the nature of how my investment is taxed and may change my expectations. I'll skip over delegation of authority, though deciding who has authority, under what circumstances they can exercise it, and what's the scope of that authority can be something that's negotiated often in a minority equity investment. And then a minority equity investor is often going to want some kind of information and reporting rights. It could be quarterly or annual financial statements, budgets, operating information, notices of specific events, such as termination of material contracts or lawsuits, and maybe have inspection rights too, where they can go into the office, inspect the books and records of the company. Those are often areas of negotiation in these types of transactions. So another area which is commonly discussed and addressed are equity transfers. So in a private company, you just can't freely transfer your equity, buy and sell it like you would with a public company that has shares on some kind of national exchange, like the New York Stock Exchange or NASDAQ. There are more regulatory restrictions or legal restrictions on that equity. And then often there are contractual restrictions on that equity. So the ability to transfer equity may be different if it's preferred versus common versus incentive. And a lot of times people are talking about, well, I want to be able to transfer equity to family members or to estate planning vehicles that I might create or other companies that I control, and want to be able to, have my equity transferred at my death to a family member without any ability to buy back or claw back that equity by the company. And these things are often negotiated and documented in the corporate or LLC documentation for that transaction and for that company on a going forward basis. Changes of control. So if I form a company and invest in another enterprise, and then I sell the equity in my company, that's really another way of kind of getting around a transfer restriction, is allowing another entity or another owner to come in to my entity that holds the equity position. So owner changes of control often come into play as well. In private companies, there may be restrictions on transfers to competitors because there's a concern about that. There are very commonly rights of first refusal, where if I'm an owner in a company, I've found a third party who wants to buy my equity position in that private company, and we negotiate a deal, I have to take that deal back to the company or maybe another group of stockholders who can buy my equity on the same terms and conditions. And a lot of times those rights of first refusal just act like consent rights on transfers. They have a chilling effect because no one's going to do the diligence and spend the time and money to look at my equity position and underwrite it and figure it out when the deal can just be taken out from under them by right of first refusal. So right of first refusal often turns into getting a waiver of that right in anticipation of a transfer. But there can be variations on the rights of first refusal called rights of first offer, rights of first opportunity, and a lot of other derivations, which are something a little bit short of a pure right of first refusal, but still have some similar effects. Tag-along rights. A lot of times you'll hear these called co-sale rights as well. So if I'm an owner and I'm a minority investor and I buy a minority position in a company and the founder owns the rest of it, there's that founder, if they're going to sell a portion of their equity, that might be my best opportunity to monetize my investment as well. So if they plan to go out and sell a portion of their equity, I want to be able to tag along. I want to be able to co-sell with them on the same terms and conditions. And tag along rights or co-sell rights can get complicated when there's a lot of different classes of equity and the capital stack is somewhat complicated. And there's a distribution waterfall that's complicated. And so those need to be put together and structured very carefully, and they're often negotiated. But tag along rights or co-sell rights is a common term you see in minority equity investments. Drag along rights are sort of the converse. So the structure of a transaction may end up being where the company can decide and the board can decide and the stockholders as a whole can decide to sell the company, or it could be structured as a transaction where each individual stockholder or owner has to participate directly. A drag along right helps to keep those transactions operating in the same manner. So if the board and the majority of the stockholders could cause a merger of a corporation as a liquidity event, if those same groups want to sell the company and it's a direct stock sale or every individual has to sell their shares, a drag along right allows those same groups to drag every other minority stockholder and participate contractually so that the form of the transaction doesn't change how it's approved or how it can be accomplished. Redemption rights or call rights are not infrequent. Companies may want to be able to buy back equity from minority equity owners if they've breached the corporate documentation, they've engaged in a invalid transfer. If it's an employee, their employment is terminated. You'll get into what's the pricing associated with that. Is it fair market value? Is it a discounted value? If there's been some kind of bad act involved, is it cost? And how is the purchase price paid? Is it a lump sum? Is it over time? Is it in a cash or in a note? All these things are important. And so this kind of brings us to exit strategies generally. Minority investors are going to be worried about their liquidity. How do I get my money back and how do I get a return? And that's where we talk about tag along rights. It may be an ability over a certain period of time to force the company to engage in some kind of auction or sale process. There are registration rights that a minority investor may get where if the company does go public, the investor can include some of their shares as part of what's being sold in the public offering. And then redemption rights and put rights, as we talked about generally. In a sale transaction, corporations, if they're doing an asset deal, selling all their assets, again, there's two levels of tax, both at the company level and at the owner level. A stock deal, there's just usually one level of tax. An LLC taxed as a partnership, you're usually getting one level of tax regardless of the type of transaction. And so one other aspect that comes into play with minority and equity investments is the purpose and the rationale behind the person making the investment. Again, are they making a financial investment or do they view themselves as a strategic investor? If it's a strategic investor, let's say I have a company, I'm making an investment in another company that produces products that I really need to use in my business, but they're just getting started. And it's a really early stage deal. But as they get more mature, as they grow, and maybe my business becomes more reliant and dependent on their products, I may want to have some kind of right to buy them at some point. And so I may want to negotiate a predetermined process or price to get to that sale transaction. I may want some kind of right of notice if they ever go to sell to somebody else, so at least I can try to put a competing offer out there. I may want a right of first negotiation where before you go talk to anybody else, you have to come to me and I have some kind of exclusivity period where I can try to persuade you to sell the company to me. Or it could even be something as extreme as a right of first refusal, as we talked about earlier with equity transfers, where if you go get an offer to buy the company, I can take it out from under that potential buyer and buy it on the same terms. Those are pretty strong provisions that you don't see in that form very often, but they do exist. And so the type of investor you may have may influence some of these types of terms that they're seeking when they're choosing to make a minority equity investment. And so I know that was really fast and high level and going through a lot of topics that any one of them could be an entire webinar on themselves. But I wanted to provide an overview for the types of issues and matters that are often discussed and negotiated and dealt with in a minority equity position and minority equity investment. And I know that we're limited to about 40 and 45 minutes for our time, and but we're now open for questions or any comments, and happy to provide any additional information that might be requested.
Perfect. Thank you so much, Jeffrey. That was so informational. I see that we have Joanne in the chat. Joanne, did you have any questions today? I did have a question myself. So I know that you discussed joint and minority owner. With joint and minority owner, how does that work exactly? I know you said that one of them, they have a little bit more ownership. Can you dig in a little bit deeper on joint and minority owner?
So when I'm using the word joint in this context, I'm thinking about a joint venture. So you may have two businesses who want to create a new business that's owned by the two of them. They want to create a joint venture. And that would be a separate company that has its own business and operations, and it's governed and managed and operated by these two company owners. You can have a 50-50 joint venture. Those are complicated, but oftentimes one company excuse me, is putting in more capital or more assets that represent a majority of the value of that joint venture. And so in that context, the other company who's going to have a minority equity position, less than a majority in that company, they're going to want to ask for a lot of those minority equity rights that we talked about.
Gotcha.
And so that's why they come up in joint venture context. That's not purely just an equity investment. These two companies may be putting cash, but they may be putting assets and other things into this joint venture. But it's just another example of when these minority equity rights exist.
Perfect. And Joanne did have a question. She said, if someone is investing as a private investor who wants to take an active role as a manager in the company, what would be the best course of action for the LLC and the investor?
So it depends on what level of involvement that person wants to have. So when I hear that someone wants to be a manager, that could mean a lot of things to me. It could mean that the person wants to have somewhat of an active role in big decision making, strategic decision making, and big inflection points in the company's growth and history. That might be the context where they're on a board of managers or on a board of directors. So if you have a board made up of three individuals, that investor may have a seat on that board. And so they're not controlling board actions, but they are participating in them and they have a voice. They may want to carve out a set of actions where, no, you can't do these things without my specific consent. But that might be one level. In other situations where you're putting together a management team and someone's making an equity investment and they're really almost a founder, they may have an employment position with the company as well. So it may not be just a manager position or a director position, but they're an employee and they're getting incentive equity in that context. So it can be a couple different situations. It depends upon the facts and circumstances, how big the equity investment is, and what kind of role, how active a role they want to have.
See. And Joanne, what I'm going to do is allow you to talk. I'm sure you had a question after that.
Sorry.
Yes, thank you. Can you hear me?
Yes.
Oh, awesome. This was amazing.
Thanks.
So very much. You have no idea. So I'm going to be very transparent and tell you a little bit about my situation. I am an LLC. I have a publishing company that I started in 2019. When I started the company, I have a very good friend who years ago, we had always talked about starting this publishing company together. In 2019, she wasn't in the position because her mom was going through dementia. So she wasn't able to join with me. So I just went ahead and started my company. Over the last 4 years, we have grown significantly. We average so far since 2019 when we started to now, we have done about $500,000 in just publishing books, right? And writing books, right?
That's great.
It's pretty amazing for a company that's built from a computer out of a office in my home. Now her mom has passed away and she has gotten a divorce and she came into some money. So she called me in October and we were just talking and she said, the one thing I'm guilty of was that I never decided to start the company with you in 2019, but I have watched you grown and I've seen how you bootstrap your way and I've seen you all over social media and I'm so proud and I love what you're doing and I want to invest in you. So that's what she said. It took me aback for a little bit. And then we talked over some time. And she said, I have $35,000 that I want to invest in Victorious You Press, which is the name of my company. And I would be willing to come on board and manage the operational side for you because she's so strong operationally.
Mm-hmm.
So that's where we are. And honestly, I need the operational backing because I do have a team 99, but I'm running everything, the sales and the operational side, but I know her strength because I know her and I know her character and I know, things about her. So when you talked about having that knowledge of the person prior, right? It's not like solicitation.
Oh
So
yeah, no. That's not a general solicitation
right.
at all, certainly.
So I'm like, okay, so I'm not soliciting. And this was her approaching me because I would have never known that she would have wanted to invest. And so that's where we are. I want to make it legal. I want to do the right thing. So I reach out to Climb because I've worked with them in the past. I'm a co-executive director of the Boost Pad. So I know Climb. And so this is how I was got the information to be on the call. So my thing now, how do we set it up in the right way so that um you know I first thought about the what do you call the convertible, the
Mm.
convert,
That
right?
could-
Right. So at first I said, okay, well, maybe you can come in to the company and you could, and this 35,000 could be a loan, right? But not repayable until about 2 years from now. And then we will give you an understanding of, you'll get a chance to see what the company is, and then we can start paying on the loan in 2026. However, if you see that you love us and you want to be a part of us, then maybe we can convert it to an equity. So that's kind of where I was first, but this has given me a lot more understanding of all the different type of investments. So that's why I'm on the call.
Right. Well, and I mean, and to be candid, I think like I would engage a lawyer on this, and because my mind is just racing with questions that I would have for you if I was going to provide you advice in that context.
Yeah.
And it can be structured in so many ways and so many customized ways.
Mhm.
I think you need to start with, what do you want from a business standpoint? It sounds like you do want this person's services. They can add value to your business.
Yeah.
So, do you want to say you have to invest now? It's not going to be a loan. You have to invest now,
Mhm.
and talk about what kind of rights that person has.
Okay.
Um, it sounds like you've developed something pretty meaningful and valuable on your own. So you'd have to figure out, what is the value of my company now? What does $35,000 buy?
Right.
And if it's not working out, or if I change my mind, how easily can I break this apart? Can I buy you back out at your cost, or at some appreciated value, at a fair market value, at a value we agree upon that's formulaic based on at the time? There are lots of questions um, to be asked and issues to be considered about what you want, and then you're putting together that kind of package and then trying to balance it and negotiate with what she may want for her
Right.
money as well. But you're in a very different position than you were in 2019.
Yes,
So
sir, I am. And
yeah.
I have an email list of over 2,000 people and 10,000 social media followers.
Mhm.
So she's coming into something that I like single-handedly built, and that has value. Even my 2,000 email list has value.
You're right.
You
Right.
know, that values a lot, because if all 2,000 said, yeah, I want to publish, and we're looking at $5,000 as an average for publishing, that's a lot of money.
Yeah.
Well,
So
thank you, Joanne, so
yeah,
much for sharing that. I think that was a great question, especially whenever viewing and looking at future content, just trying to figure out how to navigate that space. And I would love to pair you up with one of our attorneys in our brief advice and counsel session, so they'll be able to speak with you one-on-one and give you a little bit more advice. But that was a great question.
okay, thank you so much.
It is
And
my
best of luck. That's great.
Thank you, sir. Appreciate it.
Yes. All right. And I think I want to piggyback off of what Joanne was saying about the solicitation and pre-existing relationships with investors. I never knew that. Whenever you were giving me that, I was like, wow, you learn so much in each webinar, but I think that this one was super great, especially whenever speaking about investments. So I cannot thank you enough, Jeffrey, for joining us today. It has been great. Also, thank you everyone for attending and participating and viewing this. The webinar will be available within a week on our website at ncbarfoundation.org. I would like to thank our program partners as well, Mount BizWorks in Asheville, Prospera and Climb in Charlotte, and the small business hubs at Fayetteville State and East Carolina University. If you have any additional questions, please reach out to us by email at foundation@ncbar.org. Thank you all again and have a great day.
Thank you very much.
Thank
It is
you.
my
Bye.
pleasure.